In this video, I will give you a quick overview of what characterizes central banks and their objectives. I will also give you some examples of existing central banks. But initially, it is important to know that central banks are independent institutions and thus are not part of a government. Therefore, they should be unaffected by any political intentions. What do they exactly do, and what are the objectives of their monetary policy? Well, to answer this question, we should first look at our starting situation. As you might have experienced, prices for almost all goods and services rise over time. We can see that, for example, by observing ice cream prices. Nearly every summer, the price increases. But luckily, this price increase is not very dramatic. Here, the price rises constantly, each year, by about 2%. So, knowing that the prices rise in a stable manner, you can already estimate how much more you will have to pay for your ice cream next summer, so you can plan your budget for it. This stable rising of prices is exactly what central banks try to achieve. Through a constant growth of the general price level, price stability should be guaranteed, to give people confidence to make plans in the future and decrease uncertainty. Now, let's list a few examples of central banks in the world. Starting with the EU, the European Central Bank, or ECB for short, aims at guaranteeing price stability by targeting a particular price increase of 2%, also called an inflation rate of 2%. The central bank in the US is the Federal Reserve System, or the Fed for short. Its aim is price stability and a low unemployment rate. Every country has a central bank conducting monetary policy. To name some other examples, the Bank of Japan, the Swiss National Bank, the Bank of Canada, the Reserve Bank of Australia, or the Central Bank of Western African states. To achieve their targets in the economy, the central banks implement what we call monetary policy. But what does this term stand for? It is a process by which central banks increase or decrease the money supply in the economy. In this way, central banks build a foundation for economic growth and a stable development of the economy. So, what are the tools available to central banks for this purpose? I will give an answer to you to this question in the next videos, starting with the role of interest rates and continuing with the concept of quantitative easing. For now, thank you for your attention and see you next time.